Good afternoon and good morning, everyone, depending on where you are joining us from. Welcome to the third day of our special 4-day webinar series, The Midway Mark, Reflection and the Road Ahead for 2025. My name is Bella Wang from Mysteel, and I'm honored to be your moderator for today's session, co-hosted by Mysteel and Horizon Insights. As the largest Chinese commodity market intelligence provider, Mysteel offers the first-hand database sourced directly from the market. Our Chinese database provides unparalleled coverage across every aspect of the commodity value chain, offering the most granular insights available. Mysteel is committed to international data governance standards, ensuring the reliability and accuracy. Notably, it is the first IOSCO-compliant Chinese price reporting agency in this space, guaranteeing regulatory compliance and credibility. Horizon Insights is China's leading private institutional investment research provider. It specializes in China-focused macro and commodity research, providing not only directional views on commodity prices, but also actionable trading strategies. By leveraging their extensive domestic industrial network and global reach, it helps institutions make informed decisions and capture opportunities in dynamic markets. As we reach the halfway point of 2025, global markets continue to navigate a complex and rapidly evolving landscape. This year, we saw significant policy shifts, ongoing geopolitical tensions, and heightened market volatility. These challenges have also created opportunities for investors and traders to rethink strategies and identify new areas for growth. So, with the combined expertise of these two teams, we are here to help you navigate the complexity of the Chinese commodity market and make data-driven investment decisions. This 4-day event is designed to provide a comprehensive outlook for the year ahead. Last week, we examined the macroeconomic landscape and analyzed the transitioning oil markets in the first two sessions. And tomorrow, we'll bring this journey to its conclusion with our final session, Decoding the Critical Materials Market, where we'll dive deep into copper and lithium carbonate. And today, we're excited to bring together a distinguished lineup of experts from two organizations and offer you a comprehensive value chain perspective to analyze China's ferrous market. The session will unpack key supply and demand drivers, navigate price trajectories, and equip participants with both macroeconomic context and tactical trading frameworks to support informed decision-making for the coming half year. And before we begin, just a few quick housekeeping items. We have received quite a lot of questions before the webinar. Most of them will be addressed in today's session. For those that are highly specific or broad in scope, we may not be able to fully cover them today, but we will follow up with you after the session. In addition, we encourage you to leave your questions in the Q&A box. Selected questions will be answered during the webinar or in the Q&A session over the last 10 minutes. Today, we have 3 speakers. The first part about market fundamentals will last about 25 minutes. In the second part, we will have 2 speakers talking about short-term trade opportunities and strategies. All attendees' microphones will remain muted during the presentations for consistency. Finally, a quick disclaimer. The content presented during this event is for informational purpose only and does not constitute formal investment advice. Horizon Insights and Mysteel are not liable for any decisions made based on the information shared today. Please consult professional advisors for specific investment, legal, accounting, or tax matters. All right, let's dive straight into our agenda. Please join me in welcoming Vivian Yang, Head of Editorial and Steel Analyst at Mysteel. Vivian leads the editorial team at Mysteel Global, overseeing its daily operations and content strategy. With over a decade of experience at China's premier English language media outlets, including Global Times and Shanghai Daily, she brings a seasoned journalist's perspective to commodity market intelligence. Since joining Mysteel in 2021, Vivian has specialized in China's ferrous metals sector, combining her sharp editorial acumen with deep industry expertise to deliver actionable market insights. She will analyze the market fundamental shifts in China's ferrous market during the first half and provide the second half outlook. Vivian, the floor is yours.
Thank you, Bella. Yeah, all good, right?
Yes, we can see your screen.
Okay, lovely. Thank you. So hello, everyone. Welcome to our latest online sharing on China's ferrous market overview of half one and the outlook for half two. So for this session, I mainly cover some key developments and hot button topics of major ferrous commodities, including finished steel, iron ore, coking coal, and coke, and steel scrap. So let's get started. Okay, let's take a look at the finished steel sector first. So Chinese steel prices remained weak in half one, as the top graph shows. Mysteel's steel scrap index had been fluctuating in a narrow band. And by product, CRC saw the largest price drop at 14% compared to the beginning of the year. And the rebar declined by nearly 9%, and HRC fell by 8%. And medium and heavy plate prices experienced the smallest drop of around 5%. So despite the weakening of steel prices, the steel sector saw a remarked improvement in profits. So the Chinese steel makers earned 14.6 billion yuan in the first half, as against the losses of 310 million yuan during the same period last year. So the recovery in the steel sector's profits is largely thanks to steeper price declines of steelmaking raw materials than finished steel prices. Specifically, coking coal and coke led the decline, with coking coal dropped by more than 20% compared to the beginning of the year, and the coke down by even larger, more than 30%. Iron ore prices declined by 9%, and the steel scrap also down by 9.2%. So iron ore prices remain the most resilient among all steelmaking raw materials. And if we look at the bottom graph, it shows that this half-one's profits for the steel sector have already succeeded the total profits for the entire years of 2024 and 2022. Well, of course, despite the improvement in profits, the steel sector's overall profitability will remain low this year compared with early years from 2016 to 2021. And now let's look at the steel supply and the demand side. So during this year, half one period, China's crude steel output was down by 3% year-on-year to near 115 million tons. As the left-hand side graph shows, the overall production drop in half one was largely contributed by steep declines in output during May and June, these 2 months. And behind the decline was Chinese BF and EAF mills strengthened self-discipline on their production, as the right-hand side graph shows. There are basically two major reasons for mills' controlled production levels. So the first is that China's steel output control policy remains in place this year, as the government work plan in this year's top political meetings stated in early March. And the second is that the steel industry has been strengthening self-discipline in production control since Q2, responding to the national call to resist against anti-evolution competition among many Chinese domestic industries and enterprises. So this production control effort is also reflected in steeper declines of steel raw materials prices in half one, because mills controlled their steel production in response to weak domestic demand for steel. So demand and prices for steelmaking raw materials will also drag down accordingly. And now let's move to the demand side. China's apparent crude steel consumption in half one declined by around 4% year-on-year, according to our estimate. On the other hand, crude steel output was down by 3% year-on-year. So the demand decline was still larger than output. And if we look at some major downstream steel consuming sectors, the real estate market remains the major drag on steel use. But the bright side is that the property market has been moving toward stabilizing and halting the downturn in half one, with more than 340 supportive policies being introduced and taking effect during the period. Notably, the declines of key indicators, including sales area and the sales value, have narrowed by a large 16 and 11 percentage points, respectively, compared to the same period last year. Actually, it has been a common consensus that China's housing market is still bottoming out and will require greater policy support to stabilize the market and prevent it from further decline. We can also see that recent central government statements on stabilizing the real estate market have shifted from continuously consolidating to greater efforts, implying that stabilizing and halting the downturn remains the main policy direction. And repairing residents' balance sheets is key, and a new round of supportive policies is expected to be introduced in the current half. But anyways, steel demand will remain subdued because new starts continue to struggle, as we can see from the table that newly launched products still recorded a double-digit decline of 20% year-on-year in the first half. And on the other hand, the demand gap, especially for construction steel in particular, left by the weak property market, has been partially offset by the infrastructure sector. As China's issuance of special purpose bonds accelerated in half one, with local governments raising over 1.8 trillion yuan by late June. That was also a 36% increase year-on-year. Infrastructure investment has been driven stronger, and the use of these funds has also expanded into new areas, such as the, local governments' debt refinancing and clearing government's arrears to enterprises. And new special bond issuance is expected to speed up further in the current half, supporting fiscal policy goals amid ongoing economic challenges. As special purpose bonds play a supportive role in infrastructure investment, we expect this sector will continue to shore up steel demand in the second half. And then let's look at the manufacturing sector. This sector has undoubtedly become the main driver of steel demand in recent years. As the tables on this page show, all major manufacturing subsectors, including automobile, white goods, shipbuilding, and construction machinery, maintained steady growth in half one, thanks to China's pro-consumption policies and other stimulus to expand domestic demand. Mysteel survey actually show a 2% year-on-year increase in China's flat steel consumption in half one, which was largely driven by the manufacturing sector. And specifically, HRC consumption under Mysteel survey rose 1.1% year-on-year, and the CRC was up nearly 2%, and the medium and heavy plates were up by 3.2% year-on-year. So this increased steel use in the manufacturing sector is largely against the backdrop of the two renewals policies to promote large-scale equipment upgrades and the trade-in programs for consumer goods, and the surge in rush exports amid tariff uncertainties in the first half. Okay, so we've talked about China's domestic steel demand performance, and now let's see the overseas demand for Chinese steel products. China's steel exports maintained very strong momentum in half one, with the total volume rising by 9.2% year-on-year to over 58 million tons, as the right-hand graph, left-hand side graph shows. China's strong exports were driven by a few sectors, including the price advantage of Chinese steel products, as the right-hand side graph shows, and also the subdued domestic demand that we have talked about, and a relatively firm demand for steel in Asia, as this bottom table shows that among the top 10 destinations for China's steel exports in half one, 9 countries were in Asia. Well, of course, another major factor behind high steel export volume was the fact that Chinese steel exporters have accelerated their shipments due to tariff concerns and restrictions throughout the first half. And an interesting note is that of all exported steel products, billet performed surprisingly strong. The volume actually tripled year-on-year to near 6 million tons in half one. Besides this export surge is the price advantage of Chinese billets, firm steel demand, yet limited rolling capacity of those emerging markets, and more importantly, tariff advantages. And most importantly, tariff advantages, as Chinese steel exporters can enjoy near zero rates on billets and can also buy re-rolling to bypass finished steel duties among some countries. All right, we've covered most parts of the finished steel sector. Now let's take a look at the raw material markets in half one. Let's take a look at iron ore first. So steady hot metal output and record high steel exports in half one underpinned feedstock demand of iron ore among Chinese BF mills. Imported iron ore prices in the country still tracked lower overall in the first half. As we can see in the line chart on the left, Mysteel CDEX 62% Australian fines had gained some ground at the beginning of this year, notching an intra-year high of $109 on February 20th, as ore shipments from Australia were disrupted by some cyclones. But then the index gradually tracked downwards in the following 4 months under the pressure of recovered ore supply, intensified tariff intentions, and a weak outlook for China's domestic steel demand. And by the end of June, the CDEX lost 7.3% from the year's start, averaging around $100 in the first half. The price table on the right side also show that spot iron ore took a bigger hit than seaborne cargoes. This slightly narrowed import arbitrage opportunities for traders. Well, of course, iron ore prices still showed more resilience than other steel-making raw materials like coke and coking coal in the first half, as we've mentioned earlier. And most Chinese mills maintained a relatively steady purchasing appetite for iron ore, especially for medium and lower grades. In the spot market, the price spread between 65 Carajás fines and 62 PB fines at Qingdao port contracted continuously from 120 yuan per ton at the year start to 97 yuan per ton by the end of June. This was also because compared to the modest seasonal decrease in Brazilian iron ore supply, Australian ore witnessed a more evident reduction due to the frequent cyclones in the first quarter. And the price spread between Carajás fines and the super special fines also narrowed by nearly 40 yuan per ton. Another notable trend in the iron ore market in half one was the strengthening of lump premiums. This was mainly driven by lower lump stocks at Chinese ports and the extended softness in coke prices, which made lump ore a more attractive option for mills looking to control their sintering or costs and maintain stable operations. Now let's move to the coking coal and the coke markets. So in half one, China's coal and coke markets were generally grappled by a severe supply glut, with prices continuously battered to hit record lows, as this top graph shows. For the coking coal market, its trajectory was more dominated by supply changes during the period, against the backdrop of relatively steady hot metal production at BF mills. The most time of half one saw a stubborn oversupply, tugging coking coal prices as downstream buyers aggressively lowered bids to control costs. Despite the rumors about the supply reductions circulating since early June had lifted market sentiment for several times, a firm market rebound didn't emerge until late June, which further strengthened in July. The change was mainly supported by the East supply surplus, as strict safety and environmental checks still disrupted coal production in some areas during June. Besides, the outlook for tighter Mongolian coal availability due to the imported festival in mid-July had intensified in late June, and the market chatter that China would move to crack down on overproduction activity following recent investigations in the 8 major producing provinces, which further raised expectations for tighter coal supply. Meanwhile, speculations that Beijing may carry out a new round of supply-side reform in key sectors also fanned bullish microeconomic prospect. And the announcement for construction of a mega hydropower project in Tibet also boosted the demand outlook for steel products. All this give an upbeat picture of demand for coke and coal markets lately. As for China's met coke market, it had experienced 10 rounds of price reductions in half one, totaling 520 to 570 yuan, except for a 50 yuan rise in mid-April. July has seen actually by today 4 rounds of successful price hikes so far. And let's take a look, also take a look at the coal and coke inventories. A review of Mysteel data shows that the imbalance of Chinese coking coal market was severely worsened by strong imports last year, lifting China's coking coal stocks and stifling rebounding chances for the market in this first half. By late June, total coking coal stocks in China were higher by nearly 13% year-on-year to over 36 million tons. But the stock accumulation showed signs of easing in July this month due to quickened sales and slowed production. Meanwhile, we observed the typical inventory distribution pattern, which means more stocks being held by the demand side, experienced a clear shift from the second half of last year, with stocks on the supply side way higher than those of buyers, as the bottom graph shows. But from the line chart on the also on the same graph, we could find that there's a chance for the demand side to hold more stocks, as their purchases remained active in the short term. By mid-July, China's coke inventories remained higher by nearly 14% year-on-year, contributed mainly by stock pile-ups at independent coke plants, as the top right table shows. And on the import front, China has tightened quality checks of imported coal in half one, hoping to mitigate supply surplus in domestic coal market. Accordingly, China's coking coal imports in the first half declined by 7.4% year-on-year to over 52 million tons. And the full year volume is likely to come off a record high of 120 million tons during last year. In first half, among all suppliers, Mongolia and Russia contributed to a combined drop of nearly 5 million tons of China's total coking coal imports, while the tariff-led cost increases have also stagnated coal traders with the US from May. By contrast, coal shipments from Canada increased markedly, while Australian coal still failed to secure steady shares in the Chinese market due to its poor cost performance. Okay, finally to the steel scrap market. So in the first half, China's steel scrap market faced ongoing supply tightness, with the volume down by 2.5% year-on-year. This is mainly due to the sustained downturn in the real estate market. So the slowed demolition progress in domestic building sites hindered Chinese scrap yards collection and processing, as the right-hand side graph shows. And meanwhile, scrap imports were also minimal, as the bottom left graph shows. The scarcity of scrap imports was due to the wide price gap between the materials at China's home market and those in the overseas markets. So far this year, the average import price of HS scrap from Japan was around 334 US dollars CFR per ton, higher by 38 US dollars per ton than the heavy scrap in East China's Jiangsu province. Given the strict restrictions on scrap imports imposed by the Chinese government, only high-grade scrap was allowed to be imported. And the supply of such materials is shrinking around the whole world. So it is natural that overseas resources are much more expensive. In fact, the tight availability worldwide has subdued the global trading of steel scrap. The report from the Bureau of International Recycling shows that major scrap exporting bodies, such as the EU and the US, saw their scrap shipments drop significantly in 2024. And on the demand side, Chinese steelmakers' consumption of steel scrap was largely stable in half one. On one hand, Chinese EAF makers' demand only increased marginally in half one, as the mini mill's overall capacity use was only slightly higher than the same period last year. And on the other hand, BF mills grew increasingly reluctant to use steel scrap as a feed material, since the tight supply has made scrap prices more expensive than iron ore and coke. So it is less cost effective than hot metal. As such, Mysteel survey shows that in first half, the average scrap ratio in the feeds used by 130 BF mills was lowered by 1.5 percentage points year-on-year to around 30.4%, as the right-hand side graph suggests. All right, that's enough for the half one overview. Let's now move to the half two outlook for China's ferrous commodities. So first for the finished steel market, the overall supply and the demand imbalance may persist in the second half. On the supply side, crude steel output is expected to decline further due to both mills' self-regulated and policy-led controls on production. For steel mills, half one significant recovery of their profits has proved that strengthened self-regulatory on production did actually work. So it is reasonable to believe that more and more mills would adopt this kind of operation strategy to proactively adjust their steel production, especially after key steel making raw materials, including iron ore, coking coal, and coke, have increased by large degrees recently. And such price increment would have significantly increased the steelmaking costs, and thus would erode steel mills' profits. And from the policy perspective, we believe that although this round of anti-evolution policy has had some impact on the ferrous industry chain so far, the impact will remain largely limited. Why is that? Because the steel industry is not expected to be the primary focus of this round anti-evolution efforts, as the current profit margins in the steel sector are still much better than in 2015, when the first round of supply-side reform was to be introduced. Actually, other than the steel sector, some end-using manufacturing sectors, such as photovoltaics and new energy vehicles, are experiencing more intense internal competition and therefore receiving greater policy attention. So as a result, within the steel industry, we believe the focus going forward in half two will remain on production control measures driven by environmental inspections, energy conservation, and carbon reduction goals. And we estimate this year's total crude steel output to decline from last year's 105 million tons to sit between 190 to sit between 990 to 980 million tons. And on the demand side, China's domestic steel demand will remain weak in the second half, with the property sector remaining the major drag, while infrastructure and manufacturing sectors largely supporting the overall steel use. Specifically, the real estate market will stay in the bottoming and transition phase, and with newly launched projects declining by around 18% year-on-year by the year end. And while steel use from the infrastructure sector may see a modest increase with greater fiscal support and accelerated fund allocations. And in terms of manufacturing, the growth rate of steel demand from this sector is expected to slow down in the second half. And if we look at by subsectors, production and sales of automobiles and white goods are expected to slow down, while steel demand from shipbuilding and machinery sectors may maintain the growth momentum. And on the export front, China's steel exports may remain elevated in the second half, but the volume may fall compared with the first half, as greater global headwinds, including subdued manufacturing activities and ongoing trade friction, are expected to limit export opportunities. And moreover, aggressive front-loading of Chinese steel exports since earlier this year to beat potential tariffs has likely pulled forward demand, setting the stage for a slowdown, maybe starting from September. So we project this year's total steel exports to remain little changed from last year's volume to around 110 million tons. And as for China's apparent crude steel consumption this year, we estimate the volume to slightly decline from last year to around 890 million tons. And as for iron ore outlook, we are likely to see more changes in iron ore market fundamentals. On one hand, with new capacity from Simandou in Guinea and other new projects in Libya and elsewhere gradually coming online, global iron ore supply is expected to increase in the second half after it fell short of expectations in the first half because of the weather-constrained shipments from Australia, as showed in the bar chart. And we estimate the supply of imported ore in the second half may rise by around 6 million tons. And for China's domestic ore, Mysteel survey among 433 miners across the country show that their iron ore concentrates output in half one was 8% lower year-on-year. But with an expected recovery in the current half, the full-year output of domestic concentrates may remain largely stable compared with last year. On the other hand, China's demand for imported ore may soften as hot metal output at mills has gradually retreated from its high point. And the loose supply and plus softer demand will see the inventory of imported ore at Chinese ports may build up again. Specifically, total stocks of imported ore at 47 Chinese ports declined clearly to hover around 144 million tons by June. But the stocks could climb back to around 160 million tons level in the current half. In the supply surplus scenario, and thus may weigh on iron ore's prices. The benchmark Mysteel CDEX for the current half is expected to average around $90, and the average price, the index price throughout the year may reach $95 per ton. Another thing that has drawn wide market attention this year is the decline in the ferro content of mainstream and mid-grade Australian iron ore fines. Since mid-May this year, Rio Tinto has started shipments of its new PV fines, with iron ore content reduced from the original to the current 60.8 And the BHP also lowered the iron content of its flagship products last year, such as mining area C fines and Newman high-grade fines. So to reflect the ongoing changes and better serve market trading, Mysteel has launched the seaborne 61% fines index in ore grades in Australia's Pilbara region, while also updating the existing seaborne 62 Australian fines index. And now let's take a quick look at coking coal and coke markets. So the outlook for these two commodities is full of uncertainties and changes. Although the recent market sentiment lift may continue to support coking coal market in the near term, the actual effect of overproduction crackdowns on fundamentals remains unclear. Besides, the potential stricter production declines for the remainder of the year may mean further downward pressures for coking coal and coke prices. China's coking coal demand is estimated shrink further in the next decade, following below a multiple-year low of 572 million tons by 2026, and a base case scenario, as the graph shows. And China's coke production is also estimated to decline in the second half, but maybe at a mild pace due to the current acceptable profit margins for coke producers. And as for steel scrap, this commodity's fundamentals in half one seemed okay, but the scrap price still declined. It was mainly dragged by the falling prices of finished steel and other steel-making raw materials. And such downtrend of steel scrap price is expected to extend in half two, as the top left chart shows. The overall steel scrap availability will remain tight for the remainder of the year, but the total supply may expand slightly, driven by the growing scrap generation from the manufacturing sector, such as automobile, machinery, and home appliance, as the government's trading policy has significantly boosted the product phase out and renew in these markets. But scrap imports will remain low. Meanwhile, the price gap between steel scrap and hot metal may remain wide at around 100 yuan per ton, which will continue to curb scrap demand from Chinese BF mills. The tight balance between supply and demand will constrain the prices in a narrow range for the rest of this year. And so based on what we've just covered, we project prices of all major ferrous commodities to maintain their downtrend in the second half. And as this table shows, coking coal and coke will continue to see the largest year-on-year price declines, despite their recent gains. Steel scrap may follow, and iron ore will remain the most resilient among all key steel making raw mats. And such declines of raw mat prices will also continue to weigh down finished steel prices. Rebar may remain the weakest, followed by HRC, and media and heavy plates will see better price performance this year. Okay, so before wrapping up this presentation, I would like to take this opportunity to introduce Mysteel's two flagship daily reports, Steel Daily and Raw Materials Daily, and one newly launched monthly report to support your ongoing market analysis. Steel Daily serves as your comprehensive resource for tracking prices, costs, output, and inventory data across all steel categories, including long, flat, special steel, and semi-finished steel. And Raw Materials Daily delivers focused intelligence on the entire raw material spectrum, from iron ore, coal, and coke to scrap, and ferroalloys and PCI and pig iron, with detailed metrics covering prices, shipments, mine operations, port stocks, and import volumes. Steel Market Outlook Monthly provides comprehensive coverage of the steel value chain, from raw materials to finished products. It integrates microeconomic and policy impact assessments, delivers in-depth analysis of downstream steel consuming sectors, and includes forward-looking 6 month projections supported by a transparent methodology and backtesting. Each edition blends key market indicators with timely news, expert analysis, and forward-looking outlook to help steel producers, traders, manufacturers, procurement managers, and investors make informed decisions. We are happy to provide sample editions. Simply visit mysteel.net, where you will find all reports organized under the Reports and Analysis tab in our navigation bar. And for those requiring even greater flexibility, I'd like to briefly mention our online data portal, Data Buffet platform. With the embedded Excel plugin function, this portal provides seamless access to our first-hand database. It is also our charting tool that allows you to understand the seasonality. Additionally, the API data feed or Bloomberg terminal is also available for more user-friendly access. All right, that brings my presentation to an end today. Thank you all for your attention and hope you've enjoyed it. If you have any questions or inquiries, please feel free to connect me on LinkedIn. Over to you, Bella.
Thank you, Vivian. We appreciate your clear breakdown of supply chain shifts and outlook across all raw materials. So building on this foundation, I'm pleased to introduce Mengtian Jiang, iron ore analyst at Horizon Insights. Mengtian is deeply involved in the industrial trade, closely connected with domestic and international mining companies, steel mills, and traders. She has a profound understanding of the entire trade process and fundamental research. Mengtian has worked in the global strategy department of a foreign bank and a leading international trading company. She excels in big data modeling and analysis, uncovering the implicit logic behind details, and provides unique insights and forecasts on the ferrous metals market from a macro and industrial perspective. She will bring us raw material prices forecast and strategies for the second half. Now over to you, Mengtian.
Thank you very much, Bella. This is Mengtian. I'm the raw material analyst from Horizon Insights. So my presentation will be short and sweet. So in the following 15 minutes, I'm going to focus more on the price forecast and the strategies we recommend for the short term, especially for August and for Q3. So today I'll be covering two raw materials. One is the coking coal and the other one is iron ore. So I'll start with coking coal first because this is definitely the commodity that have the most attention in last few weeks. So we all saw that the price of coking coal has been rebounding drastically since the end of June. So a few reasons behind that, and there is one main reason to complete that logic, I think, is the micro expectation. So micro expectations such as the production restriction in the name of environment protection in Tangshan region, and also like President Xi's visit to Shanxi area, and also the very well-known anti-involution for now. So these are the main micro expectations that the market have that has been driven up the price of coking coal. And after the price has been up, it actually changes the fundamental of coking coal as well. So if we take a look at the chart on the right, so for this chart, for the blue line here is the price of coking coal in the DCE market, and the right line is the upstream inventory of coking coal. So by saying upstream inventory, what we actually mean is we plus the coking coal mine in China domestically, and also the port inventory from Mongolia, and also the port inventory from the seaborne like Russia, like Canada, and the US and Australia as well. So we add this together to get the red line here, and we drew it reversely. So as you can see, since the year of 2023, because of the upstream inventory of coking coal has been really high, so the coking coal price in the future market has been fluctuating along with the changes of the coking coal upstream inventory. So here, since we draw the red line reversely, if the red line goes up, it means the inventory actually is depleting. So in the meanwhile, it's natural that the price of the coking coal went up as well. So if we only look at the fundamental perspective to take a look at the valuation, so even though we all know that on Friday last week, the DC actually started to intervene the position, especially for the long position held by the traders, which caused there is a quite deep pullback for the price of the coking coal. But if we look at the valuation from the fundamental perspective alone, we can see that there is still a gap here, which means that based on current inventory of the coking coal, the price of the coking coal can continue to move upward. So if you ask me the question, if it's only a temporary pullback, or does it mean that in the second half of the year, the price of the coking coal is going to continuously moving downward? I think it's more of a temporary pullback. So if we take a look at the macro perspectives, I think they still stand. So for example, if we take a look here, so for the chart on the left, it represents the production margin of the steel mills. The blue line here is the production margin of the rebar, and the red line is the production margin of the HRC. So based on the investigation we have with the steel mills, so currently they are having the best production margin within the year. So they have production margin of more than 300 yuan per ton. So we can take a look here for what I have circled here is the production margin for the steel mills in the year of 2025. Obviously, it's so much higher than what happened in the year of 2024. So even though that we all know in Tangshan region, there is a production restriction in the name of the environment protection, which actually causes the hot metal output to have a dip in June. But at the current high production margin, the steel mills do not really have the willingness to cut their production. So for the dotted line here is what we calculated based on the maintenance schedule planned by the steel mills. So from here we can see that even with the production restriction, which we expect to continue to have before the 3rd of September, which is a day of the National Day Parade, the hot metal output is expected to continue to move upward and to be above 2.4 million tons, which means it's a very bullish number for the raw materials and support the demand of the raw material, including iron ore and coking coal. And other than that, here is a very interesting chart I'd like to show you all. So we all know that the President Xi actually visited Shanxi at the beginning of July. So we actually did consolidate what happened since the year of 2017 for the last 5 times he visited Shanxi. And the blue line here is the price of the coking coal. So we see that for the last 5 times, almost every time, so definitely every time, the price of the coking coal has bottomed out. So during his visit to Shanxi this time, he actually emphasized that the importance of the safety issue in Shanxi, especially for the coking coal mines. So which means that we do believe, even though in the future, especially in the second half of this year, even when the price of the coking coal goes up, the domestic supply of coking coal will still be kept. It is very difficult to go back to what happened in June or May, when the price of the coking coal in the DCE market is below like 720 yuan. Because at that time when we visited Shanxi, we talked to the coking coal mines there. So what we were told is that because of the low price and also of the low production margin of the coking coal mines, so some of those smaller size coking coal mines has been shut down or suspended for operation. So this is something that definitely we believe will not happen again for the second half of the year, and it definitely put a floor of the price of the coking coal. So that's another reason that why we say that the anti-evolution of the coking coal industry is actually materializing. It's materializing on the coking coal mine side. Yeah. So other than that, so there is a very important document that has been released last week. So it's about the National Energy Administration's capacity control measure. So I believe that everyone has been very familiar with it. Just to briefly go through what happens there is that 8 provinces in China will be under control and will be traced back their production since the year of 2024 until the June this year to make sure that it won't be more than 10% for their declared production capacity. So a lot of questions have been raised around the market to ask, will that mean that the production capacity or the production itself to be greatly impacted in the second half of the year? To be frank, I think it's still very difficult to tell for now, because what's important in the document is actually it's specifically mentioned that it's not only at provincial level, it will be traced down to the enterprises and individual coking coal mines. For example, if coking coal mine A in that province is under production, but coking coal mine B is overproduction, so the coking coal mine B will face being suspended for operation in the second half of the year. So that is some of the number that's still under investigation. And according to the investigation says at the end of the feedback, it says that currently the enterprises and coking coal mines is still under the process of self-check. So in the second half of the year, how much of the production capacity will be impacted, we'll still keep tracking on that number. But based on what we have seen now, currently there are some small mines already being suspended under these documents. So if we at the beginning of this slide was saying that, so we do see that the macro aspects actually have changed the price, and the price actually changed the fundamental of coking coal. So here are 2 charts I'd like to show. One is the downstream inventory. So this downstream inventory include the steel mills and the independent coking coal plants. So let's see. Actually, since July, ever after the price of coking coal went up, so the mentality of the downstream has greatly changed, and they started to replenish their stock. So as we were saying that due to those political pressure, and those risks, so we actually did observe that the resumption of the coking coal production has been quite slow, and together with the increasing downstream demand, we do observe that the coking coal total inventory, the upstream one, has been declining. So at the very beginning of this year, so the market was actually expecting to see a great oversupply status of the supply of the coking coal. But now if we take a look for the upstream inventory, it is now come very close to what happened last year. So the fundamental has changed from extremely oversupply expectation now to a tight balance. And we do believe that in second half of the year, if at least until in Q3, if we see the hot metal output continue to be maintained around 2.4 million tons, and the production resumption of the coking coal mines continue to be limited, we are expecting to see the supply and demand balance of the coking coal can be maintained. So for the trading strategy wise, after the sentiment impact of the DCE's intervention, we still look for appropriate opportunities to enter market through the long position, continue to find a buying point. So that's more for the coking coal point. So we spend a bit more time on the coking coal part because that's one of the leading commodity for all the ferrous commodities. So if we take a look at the anti-involution, it impacts more on the steel mills, it impacts more on the production of the coking coals. But to be frank, iron ore, which China is greatly dependent on the imports. So it has not really much been impacted by the supply side change restructuring. So for the price of iron ore, in the past few weeks, is more of in the state of following the lead of the price increase of the coking coal. But of course, other than that, I have to say that currently the fundamental of iron ore is actually also doing not bad, and it's still gradually improving its fundamental. If we take a look at the chart on the left, this one is a blue line is a hot metal production. Well, the red line is the profitability of the steel mills. We can see they are very closely correlated, and based on the current steel mills production margin, which normally is leading the production by 4 weeks, we do expect to see the hot metal output continue to increase in the near future. And if we take a look at the daily scrap consumption, so here is what we see being adjusted, because for the scrap, there has been heavy scrap and light scrap, so they contain different contents, different percentage of the usable steel parts. So after we do the adjustment, because in this year, obviously the light scrap has been used more, having a higher ratio for the usage. So after the adjustment, we can see that the daily scrap consumption is actually much lower than the previous years. So other than the actual good demand of the downstream, so it explains another reason why the demand of iron ore is good. It's because the consumption of the scrap is actually low after we do the adjustment. So other than that, if we take a look at the inventory. So here, this chart is the steel mills imported iron ore inventory. We can see that similar to what happened for the coking coal, the downstreams of the steel mills are also replenishing their stock so this is another reason that why the spot market iron ore price is being supported. So if we take a look here on the right, so this one, we use the iron ore off-taking volume from the ports to divide the hot metal production. So in this way, we would like to see that other than the rigid demand, other than the immediate hand-to-mouth demand, so how much of the offtake from the ports is actually based on more of the speculation. So we can see that in July, ever after the price of all the first commodities, of course, including iron ore, has been going up. So the blue line now is actually higher than past year seasonality. So this is another evidence that after the price of the iron ore goes up, so not only the downstream is replenishing the inventory, the trading houses is also taking this as a speculation opportunity. So these two factors also boosted up the expectation of the spot market price of the iron ore. So another two charts I'd like to explain is more for the future of the price of the coking coal. So one is for the iron ore arrival. So the dotted line here we plot is actually based on the shipping volume of the iron ore and their the shipment time. For example, we have different shipment time from Australia, from Brazil, or from the non-mainstream countries. So after we do the consolidation and collaboration, so here what we do expect to see is if we take a look here, so we do expect to see the iron ore port inventory in China in the July and August will continue to be lower. This is one of the main reasons is that there has been the export rush in June, which is the obviously due to the end of the fiscal year of those major iron ore mines. So July normally is their off-peak season for their shipment. So if we translate that to the arrival volume for August, given the shipment time. So for August, the arrival volume to China is expected to be lower. So after we have the demand side and also the supply side, we have the two sides of the equation. So for the chart on the right is more for the port inventory of iron ore in China. So we do expect to see that the port inventory in China for the next 2 to 4 weeks will continue to be either flat or depleting a bit. So this is the future expectation of the fundamental of iron ore that actually do support it, the price. So just to put in a nutshell, so in Q3, we're still quite bullish about the price of the iron ore and the coking coal, the raw materials, not only because of the current high demand of the hot metal output, not only because of the expectation of the policies, it's the fundamentals that from the long-term supply and demand side, we do see improvement after the change of the prices. But of course, there are some risk factors we need to pay attention to, especially for example, like the production restrictions, if it could happen. So those are the concerns from the market. But I'll leave that more to our next speaker for the downstream side. So thank you for your time. That wraps up for my presentation today.
Thank you so much, Meng Tian, for this detailed review and sharp forecasts grounded in raw material market data. Your unique perspectives perfectly sets up for our next discussion on steel price outlook. I'm pleased to turn the floor to our last speaker, Vicky Wei, Chief Ferrous Metals Strategist at Horizon Insights. So Vicky is engaged in fundamental research on ferrous metals with extensive experience in investment and research and a deep involvement in industry. She excels at uncovering details within the industry trend and combining macro and micro perspectives to provide research, insights, and trading strategies to large public and private funds, as well as sports enterprises in China. So today, Vicky will talk about the steel price outlook in the second half and decode the market's core contradictions. Now over to you, Vicky.
I did unmute. Oh, okay. Thank you, Bella. And good afternoon, everyone. I'm Vicky, Ferrous analyst at Horizon Insights. And next, I will share our outlooks on steel for the second half of the year, and maybe recommend some investment opportunities. So a hot topic in the ferrous market recently is China's anti-evolution policy. The table in this slide shows recent statements from senior management regarding anti-evolution. It can be seen that the initial trigger of broad market attention was at the Central Finance and Economic Affairs Commission meeting. We are preventing the low price disorderly competition among the enterprises and eliminating outdated production capacity were mentioned. We believe that the importance of the former, which is addressing the low price disorderly competition is currently receiving more attention than the later, which is the decapacity measures. So more relevant to the ferrous sector is the July 18th announcement by the MIIT, which mentioned that work plan for stabilizing growth in 10 key industries is about to be released. And it also noted that outdated production capacity will eliminated. And last week, the National Energy Administration began retrospective investigation into the overproduction issues over the past 6 months in the 8 major coal-producing provinces. And this is essentially not a decapacity policy. And according to the NBS data, these provinces have not shown significant overproduction in the past. Therefore, this investigation will not have a significant impact on total production beyond expectations. However, it is important to mention that the upper level policy clearly showed the intent that in the second half of this year, China will focus on managing production quality rather than to just merely pursuing the output value. So at the same time, there is also uncertainty regarding the steel production in the second half of this year. Based on the current domestic industry policy environment, we believe that the probability of imposing production limits on the steel industry is noticeably increasing, while the likelihood of capacity reduction is low. The probability of doing nothing and just allowing the steel mills to independently decide their production levels now seems to be the smallest. If we follow the rumors from the first half of the year, there's about 50 million ton reduction in the crude steel output. Then the daily average crude steel production in the second half would need to decrease by nearly 15% quarter on quarter, drop from the 270 to around 280 million tons per day to 240 million tons per day. So this is a sharp decrease. Of course, the specific production limit plans are not yet clear, but we believe that the risk of implementing production limits is increasing in China, especially in the second half of this year. So this is about the supply side. It still needs the clear the release of the documents to give us the detailed numbers. And as for the supply side, as for the demand side, steel demand is still quite strong at the moment. We know that in April and May, there was a round of pricing based on the expectations of a demand collapse due to the tariffs, especially for the indirect export markets for steel. But so far, China's export market remains robust, just as shown on the on the left picture, and disproving the bearish expectations. The steel price curve has returned to a contango structure, indicating a pattern of weak reality and strong expectations. As for demand in the second half of this year, we believe that there is little upward potential for this part of China's demand. For over half a year, domestic manufacturing production has largely been driven by the consumption stimulus from the trading policies, And this year, there are still the long-term special government bonds related to trading policies in the second half of this year, totaling 138 billion yuan, which is lower than the 162 billion yuan in the first half of this year and 150 billion yuan in the second half of last year. And also, real estate and infrastructure have not shown much promise this year and will require additional physical policies stimulus. So in the second half of this year, the focus of the steel demand is likely to remain on the indirect export markets. Special attention should be paid to the economic climate of overseas manufacturing. The pace of interest rate cut by the Federal Reserve and the progress of tariff negotiations will be both have an impact on this. And also the direct steel exports are determined by price, actually. We can see that the elasticity of the direct steel export market is considerable, primarily serving the balance of domestic supply and demand. We can see that when there is oversupply issue, the export market will increase, and when there is a shortage on the domestic market for steel, the export will show a very sharp decrease. So for the second half of this year, as for the expectations for the direct export market for steel in China, we think that if there are subsequent production limit policies for steel, which means there will be a shortage in the domestic steel market, then the direct steel export will decline for sure. If there are no production limits policies, then the export costs will serve as an upper pressure for the level on the steel prices for China, especially for HRC. So this is our basic outlooks for the steel prices for the second half of this year. And maybe that's all for my sharing today. Let me give the time back to the host.
Thank you, Vicky, for pinpointing the core contradictions in today's steel markets. It seems that our speakers have been so passionate about sharing their insights that we've run slightly over time. Thank you all for your attentive listening, and we'll now move straight into our Q&A session. So our first question goes to Vivian Yang from Mysteel. How do you assess the latest trade tension situation between China and the US and the prospects for China's steel exports?
Okay, thank you, Bella. So at the moment, all eyes are on the ongoing new round of China-US trade talks in Stockholm, as this round of talks will include discussions on extending the deadline for the suspension of additional tariffs. The 90-day suspension agreement on additional tariffs will actually expire on August 12th. So if there is no further major progress to be made in this round of talks, China's exports of manufactured goods, including particularly automobiles and white goods, may face contraction from late Q3 or early Q4. And such tariff-led pressure and other trade uncertainties will also have a bigger impact on China's indirect steel exports than direct steel exports. So that's our baseline view on this topic for the moment. Over to you, Bella.
Thank you, Vivian, for your perspective. Next, we have a question for Meng Tian from Horizon Insights. So what is the price outlook for 62% iron ore in the second half and the spread between high grade and low grade?
For the price trend of the iron ore, for example, in the SGX market, we do expect to see that the price in the Q3 will be higher than that in Q4, because as we were saying that in Q3, it is still what we call the off-peak season, and the market will trade more on the expectations other than the reality. That's for the price of the iron ore, 62%. We do expect to see the upper price range for iron ore to be around $110 around there, and the lower range in the Q4 to be around $90. And also the next question is about the price spread between the high grade and low grade iron ore fines. That is actually closely related to the production margin of the steel mills, and also whether there is going to be a production control. If for now, right, even if the production margin of steel mills is quite high, but for the steel mills, there is no strong willingness to greatly increase their production, even though they don't want to cut it, but there is no motivation for them to greatly increase it because they still face the political policy, also like the concern from the production control to be flat as compared to the year of 2024. There is no need for the steel mills to increase their usage of the high-grade iron ore fines. That's why I think the price spread between the high grade and low grade will remain quite constant, quite flat for the second half of the year.
Thank you, Mengtian, for your valuable focus. We also have a question for Vicky from Horizon Insights. What are some trading opportunities for steel in the second half this year?
Okay, sure. I think it depends. I will give two scenarios for this question. The first is if the subsequent production limit policies are implemented, then we can engage in the rebar to iron ore ratio expansion. And also the HRC and rebar price spread decrease. And we can also short the rebar October contract and long the January contract. And the second scenario is if there is no production limit policies in the second half of this year for steel, for the crude steel, then maybe we should just short the steel prices, especially when the price is beyond the, as I just mentioned before, beyond the export costs. Actually, I prefer the first scenario will have a higher probability than the second one. That's my answer.
Thank you, Vicky. Okay, all right, everyone. That concludes session 3 of the midway mark, reflection, and the road ahead for 2025. Thank you to our speakers for their valuable insights, and thank you all for joining us today. We'll be back tomorrow with session 4 for expert analysis on copper and the lithium carbonate, two of the most crucial materials for the energy transition. From strategic buying opportunities to market pivots, our speakers will unpack key supply-demand trends and the H2 trading signals. So the conversation continues tomorrow. We are excited to have you back, and bye for now.